There's a dividend structure I'm seeing Irish companies use that claims to reduce tax to about 8%. The problem is, it probably doesn't work. The idea is that the Irish company pays a dividend to a UK company. Then the UK company pays that dividend back to the Irish shareholders, the Irish resident individuals. They pay tax which on UK dividends is about 8%. And that all sounds great, but here's the problem. When an Irish company pays a dividend, the company has to deal with Ireland's dividend withholding tax, or DWT laws. When the dividend is paid, tax at 25% must be deducted and paid to revenue. Now, there are times when you don't have to apply DWT, for example, Irish Co to Irish Co. But if the dividend is paid to a non-Irish company, you must apply DWT unless an exemption applies. Now, an exemption can come from one of three places: from the DWT laws here, a domestic exemption, under EU law, such as the EU Parent Subsidiary Directive, or from a tax treaty, the treaty route. In the end, exemptions won't be of any use if you're the ultimate recipient and you happen to be resident and ordinarily resident in Ireland. If this is you, and you're paying dividends to a UK company and only declaring UK tax at 8%, then the domestic exemption doesn't apply. The UK is no longer part of the EU. Your last resort is the UK-Ireland tax treaty, but this treaty doesn't get you to zero DWT. To boot, if you think the treaty applies, you're not paying attention to international law changes. Tax treaties now include anti-avoidance rules and a principal purpose test. If your company has no substance, it's simply a conduit to pay dividends to you, treaty relief is denied. Before paying dividends to an individual or a company abroad, take advice.